is fascinating as well in his statement, in his is the operating earnings versus gap earnings they're required to report. That
the gap earnings have got the profit and loss from the stock holdings. Yeah. Stock holdings is 50% of the balance sheet, roughly.
Roughly 50 private, 50 stock, isn't it?
My flatmate is an accountant, and I love the bit where he.
When he got really angry about the CEO.
He gets so mad about CEOs bagging earnings.
But it is the problem is
it's human nature.
You look at this and it's so simple. Just invest for the long term in good companies. Quarterly valuations are our enemy.
Same here.
If I was in charge of the FCA, God forbid, the first thing I would do would be can quarterly earning or quarterly valuations.
The first year of quarterly client reports was 2020. 31st of December 2019 was the pre-COVID peak. The bottom was the 25th of March. Quarterly valuation strike point was a week later. By the 30th of June, client portfolios weren't back to where they started the year, but they were pretty much nearly there. First quarter they fell 20. The second quarter they rose about 15. Had a client had a 6-month valuation instead of a quarterly valuation. Well, they probably would have known, given what was going on. They were sat at home not doing anything, and they might have thought their portfolio had been hit. But it just goes to show, doesn't it?
I mean, they were talking about the quarterly earning releases by, the requirement for S&P 500 businesses and all listed businesses. They were talking about changing to 6 monthly, weren't they?
It's just common sense.
It is common sense.
It is common sense.
Which is kind of what we have in Europe, right? Where we have half-yearly results, don't we, and trading updates. Different countries and different stocks have different procedures and different year ends as well. That's the other thing.
So much.
It's got a June year end or something.
So much changes from quarter to quarter. It's just not. The annual is relevant, and that's about it.
It's too noisy, isn't it?
There is too much noise.
We live for the noise, don't we?
Too much noise, and then a bid to fill the noise for the next 40 minutes. Just adding to the hot air. Welcome back. We've gone for round 2. I'm David Henry, investment manager in the London office, joined as usual by our regulars, Johnny Raymond and James Hughes. How are we, fellas?
Good.
We're good. It's
survived the snow.
It's a snow day.
Well, you said last week, didn't you, or a couple of weeks ago, when it snows a wee bit, the country grinds to a complete halt, and we seem to be ticking along all right so far.
The trains are running today, and I haven't heard of chaos on the M25 just yet, so who knows? Maybe we'll turn over a new leaf.
The little people at home thought it was Christmas this morning, so that was exciting.
I was very relieved. I was very relieved the nursery was open still. I did get there and did say, "Nice to see you all in today." Can't be dealing with having 2 small children at home.
That's always a relief. That's always a relief, isn't it? Yeah. What do you make of this market?
No strong opinion. FTSE's nearly back below 8,000 now, so we can unwind everything we talked about last week.
I'm so bored. It's untrue by this market. It just feels it's range bound, isn't it?
Well, Mr. Powell ruined the party again last night, didn't he? S&P was down. Was it down 1.6?
Yeah, and down again today, fractionally.
Although Sterling
has taken a beating this week. Yeah, 118.
Probably evened it out. I'm he's range bound. I think the data's very messy still. We talk, I think when we last did this, we talked a bit about the weather, didn't we, in January?
We did.
And there's actually more and more out over the last week on that January numbers were artificially false, probably.
Yeah.
We had poor data in November and December, which is why we were all talking about recession at the end of last year, and then we've had really good data for 2 months. And now we're all talking about 6% rates.
I think the non-farms number on Friday is going to stink.
Well, it wouldn't surprise me now if we get.
I think you're probably right. But then, what does that do to markets? Because it's sort of reversed.
Puts the recession back on the agenda.
It's almost like economic projections are absolutely pointless when it comes to stocks, because you've got to get the economic projection right, and you've got to get the stock market reaction right.
Yeah.
The economic story I want to start off with is the good folks at Prét Manger getting their 3rd pay rise of the year. In my humble opinion, if anybody deserves a pay rise, it's the good folks at Prét, because they are doing the Lord's work. But that is kind of indicative of where the job market is at the moment, right?
And they're still getting cherry tomatoes in their salads, and the price hasn't changed.
Arguably overpriced to begin with, mate. Although I pay double usually.
The FT did a chart once upon a time of the story of Prét versus Greggs, and they had a chart, and there was blue blobs and red blobs, and essentially all the Greggs were north of Watford Gap, and all the Préts were south of Watford Gap, and it was just the most beautiful chart I've ever seen in my life.
I mean, Northern Ireland has just got its first Prét in the last 6 months, and I can't think of a worse place to send for Prét. Most people back home think that hummus plays centre half for Germany.
My brother-in-law and sister live in Sheffield, and I took a picture once of a veggie Prét, and the response, I can't say what the response was on this on this podcast, but it was something along the lines of, "I just give up with you Southerners."
I know. But all joking aside, like that is, it's not disinflationary, that is it? If we keep getting wage growth at the lower end of the pay scale, higher propensity to spend, probably quite inflationary.
And benefits, which is quite a big part of spending at the bottom end, are going up by the rate of inflation from 5th of April.
Are they?
So 10.7% rise in universal credit. Job seekers allowance, as it used to be known. Pensioners getting a 10.7% raise. I mean, it's quite, and again, high marginal propensity to consume. So it's a lot.
Yeah. The focus for me, this is the phrase I've sort of been using for a little while, is inflation in the cost of fun versus inflation in the cost of stuff.
Yeah.
I think inflation in the cost of stuff is over. So on screen now we've got Brent over the last 12 months down. We've got...
That's in sterling, is it?
Yeah, that's the one that you sent across.
That's
That's wheat, 12 months down. We've got lumber down 12 months. Yep. Copper, I mean, I was actually quite surprised the copper wasn't up, but even that's down. I think that inflation in the cost of fun is now yesterday's story. It's how good is the job market, how good is the consumer, and how willing are people to go out and spend money on having a good time.
Agreed. And the cost of fun is driven more and more by labour, and not as much by commodity prices as the cost of stuff, which is very commodity price driven. So if you're Prét or you're the local pub or wherever, or the local restaurant, and you can't find staff, let's put your prices up, aren't you?
Yeah, we saw it in Greg's numbers, didn't we? Yesterday or the day before was, prices are up 9%, costs are up 9%. So margin doesn't change for the time being. But you're exactly right, and I think you said it last week. We all sat at home during COVID. We had no way of spending money really except on stuff. So, funnily enough, we all bought loads of stuff, and now we're back out there. We're spending on fun, services, until that party ends, because potentially the consumer runs out of money.
Just before I go on to that thread, Greggs isn't cheap, is it, as a stock?
No,
it's a great business.
22 times earnings. It's good.
Yeah,
it's a good sort of roll-up growth story. So they've got quite a reasonable runway of growth, and I'm not rushing out to buy it on 22 times.
But that's a 10-year, 5-year average. Or is it 10-year average?
Yeah.
It's quite interesting. They're opening stores. They're doing this trial, aren't they? They're keeping stores open until 9 p.m. Actually, that's when a lot of their growth's coming from.
9 p.m.
Yeah. If you think, Dave, go for a couple of pints on the way home, sausage roll.
A sausage roll. I mean, I can come up with a very bullish narrative on Greggs based around return to work and recession and people coming back into the office because they don't want to lose their jobs. And I think I don't know the numbers, but I think Greggs are quite similar to W.H. Smith in the sense that there's lots of them in and around sort of train stations.
Service stations now as well.
Yeah.
They've got a very good template, and they know if
that's putting the price.
If they put a shop here, it's going to cost X million pounds to put the shop together, and there's a 3-year payback or a 5-year payback, and the return on capital is X.
That's where it's such a clever model, and that's where that's why it has the rating that it does. And at the moment, there is a lot of expansion still, and they're talking about doing the 24. They're doing the 24-hour drive-throughs, aren't they now? Which
Greggs.
Which I think is very smart. But no, I to be honest, I've always wondered. Not that Not that it's necessarily my go-to place, but I have walked past from time to time at 5-6 o'clock and the whole thing's shut. So it does make sense if it stay open until 9. Be interesting to see what that rollout story or what the growth looks like. But I think it's a brilliant business. That's why it's on 21 times. I guess.
Yeah, no, 100%. Before we started talking there about Greg's, you mentioned you're stuck at home, only able to spend money on stuff, and one of the themes that we talk about is that shock one-off impact of COVID. I mean, this is online retail sales growth in the UK, isn't it, John?
It's absolutely incredible. I mean, so yeah, proportion of retail sales online versus in store. So you go back January 2015. 12% of all retail sales were done online, and it sort of goes up in a very nice straight line to pre-pandemic. 20% of retail sales. This includes food, so this is foods and goods. This isn't just Amazon. And then it goes from 20% at the outset of the pandemic, peaks at 38%, and it's come right back down to 25%. And essentially, if you draw a line from the start of this chart in January 2015 to today, it's on the trend line that it was on before, and the COVID period just looks like a complete anomaly. And
it is phenomenal.
And we were never going back to a supermarket. We were all going to buy all our stuff online, all our food online, and I don't know about you, but
how depressing would that world be?
I'm pretty fed up of going back to the post office to return shoes that don't fit. Then please let me just go and try them on first.
So true.
Stop bagging for ill-fitting shoes then, John. I mean, there's a load of things like this, isn't there? There's a load of economic numbers, and COVID just breaks the chart or causes this one-off shock. The analogy I use sometimes with clients is you lob a rock into with an Irishman loving a rock, obviously. Lob a rock into a pool of water or lake or something, and the ripples start out very strongly and then sort of dissipate over time, and it does feel like that shock is sort of dissipating over time, and online sales is one of them.
It is amazing. You're right there. If you draw a line along the old trend line, I mean, we're not a million miles away now, are we?
And that line's never, it probably plateaus at some stage, but the idea of.
Well, I think we used to say
what is the right?
We used to say 30%, didn't we? We could get to.
Yeah. The UK, interestingly, this is one of the highest in the world. The UK.
Yeah.
I think the UK, maybe South Korea.
South Korea is number one.
Yeah.
If you go to the Nordics, I'm pretty sure if you went to Europe, pre-COVID, e-commerce saturation was only about 6-7%.
Yeah, much lower. Yeah.
I don't know what it is now.
Yeah. The UK
was always
and it's lower in the US as well.
Urban population, quite small island nation.
Easy to roll out logistics. Yeah, probably.
In the States, that's what do you reckon the penetration?
Well, they don't have next day delivery, do they? Amazon have only just rolled it out in the major urban areas.
Yeah.
Well, I think a lot of goods are transported by train, aren't they, in the US?
Well, it's a big old place, isn't it?
Well, you mentioned Amazon. I mean,
it's the same chart, right?
Yeah. Show me where COVID was.
Yeah.
In a similar vein, Segro.
So Segro is an interesting one. So Segro's property company, formerly known as Slough Estates, and they own warehouses and big sheds, as they call them in the business, basically in and around Slough and the Thames Valley. And if you drive up the M1 or along the M4, you see lots of these big sheds dotted around, and they're basically just warehouses full of stuff. And a lot of it's e-commerce. And Segro was one of the sort of darlings of the COVID era. And there's two sides to this story. One is this kind of story around industrial property, but the other side of it, of course, was interest rates and bond yields. So in August 2021, pretty much when this chart peaked, when the stock peaked, just before, UK 10-year gilt was yielding 0.1% a year. And you were buying Segro on a kind of 3.5-4% yield.
Yeah, which made sense.
Made a lot of sense. Now, today, the UK 10-year gilt is approaching 4%. So funnily enough, if I'm going to buy Segro, I still want my risk premium. So my risk premium is 6%. To go from a yield of 4% to a yield of 6%, the share price has to fall by a third, which is actually pretty much what it's done. It's fallen by a third.
Of course, the other thing was Amazon came out and said they essentially had too many sheds
in the States,
but focused on the Well, they sort of spun it off into the UK slightly. They came out with a later statement, didn't they?
Yeah.
But it basically expanded too quickly.
I mean,
but the last mile delivery on logistics seems to be the really interesting part of property again now. That's where kind of some of the larger property companies which have diversified assets, that's where they seem to be moving to, because actually the last mile delivery is the really tricky bit. It's where it all goes local and then they have to deliver to front door. But that's probably the interesting bit. But I once visited an Amazon warehouse, actually.
Did you?
Yeah, I went. It was organised through QC.
All right. Oh, Ollie. Yeah, okay.
It was.
That was interesting.
It was really interesting. They
Yeah.
had reels of the black Amazon tape, which went under a tiny little moisture thing, which essentially made it wet, and then it chopped automatically and went on the parcel.
Oh, cool.
It's very interesting.
I bet it was. Yeah, I love that.
We've been talking a bit about these sort of property companies in our group chat. I mean, how do you think about these things in terms of valuation? I mean, obviously, 4% yield doesn't necessarily make a huge amount of sense in a world where that's your risk-free rate, but
We've got I mean, you can go from a Segro to something like an Assura, which is very, very defensive primary healthcare properties.
GP surgeries.
GP surgeries, you know, traditional, you know, when I was younger, our GP surgery, it went through the door, it was always up the steepest flight of stairs ever. I don't know why every GP surgery seemed to be the same, and there was 2 doctors in there. It was not particularly hygienic, and you know, and now there's these very plush primary healthcare centres where you might have a pharmacy downstairs, you might have physio integrated into it, and typically, there's huge lifts for anyone to get up, but you might have 8 or 9 GPs there, and again, these are great assets, probably prior to interest rate movements. They're probably yielding 4.5, 5.
yeah,
Maybe slightly. Actually, no, probably
four,
lower.
4 rings a bell.
The rent's index linked. It's essentially paid by the government, so we were very happy taking a 4% from the government, which compared to the 0.1 from a gilt, and you've got some inflation protection as well. But that share price is probably off 35% from where it was at the high, and again, you just want that gap over the risk-free rate. Now, I think a business like Assura, or we put it on Segro or Supermarket Income REIT or whatever else, these are brilliant assets still. Do you get that capital return back quickly? No, unless rates go towards zero again. But you do get a very nice income generation. I think for a long-term client where you want some protection from this as a starting point, they're very good places to be. But you do want that. You do want that big gap, and
you want a buffer. You want a margin of safety.
Yeah,
and I think you probably are getting that in a range of these sorts of assets.
You are, and our property analyst Ollie has done a huge amount of work on this, which is exceptionally helpful. It doesn't look great if you bought these things 18 months ago, but I think if you push forward a few years and you get these lovely income streams, they're a very good place to be still.
Yeah.
You've got to be obviously careful of covenants and loan to value, etc. But we do the work on that, and we're comfortable.
Just on interest rate projections, I love this. This is the Philadelphia Fed survey of professional forecasters, aka very smart people. The dotted lines going back to 2003 are their projections for the future course of interest rates, almost entirely, without exception, hopeless. The solid green line is where interest rates actually ended up. These are some of the biggest brains probably in the world, and they can't get it right.
Yeah, it's.
Not to dunk on them, but they can't.
Well, they're all the same, aren't they? They're all up.
Did they ever get it right?
Yeah, there were a few points. 2016,
they're on a
2017,
decent run at the
2018.
Stop clock.
2012 and a half-ish, they sort of got it right.
But they're all upward sloping, right? So they've all forecasted higher rates as the next year, 18 months goes on. So they've been right when rates have actually gone up over a space of 18 months. But of course, that's not the environment we've been in for the last 10 years.
I remember 3% yield in the 10-year gilt. 10 years ago, 11 years ago. God, rates are low.
Yeah. Yeah.
And bonds, it's not like equities where theoretically they can keep going up and up and up and up. There should be a floor.
Unless you're in Japan. Or
and we
Germany.
got almost to the very, very bottom in terms of yields, but
that's great.
It's these people are much, much, much smarter than I, but I think it's just a point of
But
humility to have
the
to
other thing,
be
and
aware of this.
it's the same with the strategist S&P 500 year-end targets, right? None, like if you listen to a lot of these guys and you hear them speak, none of them actually want to give an end-of-year S&P 500 target. But it's a bit like it's not the same as who's going to win on Saturday and who do you think is going to win? Well, does it really matter? Not really. So these guys are all the same. They do actually think more in probability terms than we probably give them credit for. But the whole kind of world just asks, where do you think the market's going to be at the end of the year? And they're forced to give a point estimate, which they know is not going to be right.
I think the best S&P earning estimates are the ones that are based on calculations and statistics, which is what has the annual earnings growth of the S&P been over the last 50 years. If you stick that in a model and put it on year in year, actually that tracks pretty closely to what the S&P does. It's just the S&P does this.
Oscillates.
Yeah, exactly. So I
valuations.
think they're the best sort of end of year targets to keep around or to look at. But trying to predict the future is I'll be on a beach somewhere.
It's really, really difficult. It's really, really difficult. I got asked, I can't remember what the paper was, but I got asked to do a predictions for 2023 type thing about 2 months ago now. I mean,
how you getting on with those?
behind the sofa type stuff. I mean, bonds outperform equities. Well done, Dave.
Well done.
You're
Good
a
start
moron.
for that.
Just on the economy before we go on. Off the back of that unemployment chart that you shared with us last week, I asked Billy to segregate the returns of the S&P, similar methodology, but based on GDP. I mean, there's not a huge amount to say here other than too hot growth or too slow growth in the economy is not great for stocks. Most of the time, economic growth sort of chugs away in the middle, and in that environment, stocks do really well.
Yeah,
Absolutely.
high growth means probably high inflation and strongly rising interest rates, which is not a great backdrop as we saw last year. And low growth probably means the economy is not doing great, and therefore earnings are falling. That 4 to 5 sweet spot.
And by definition, outliers happen more rarely. So actually, probabilistically, you're more likely to be in the sort of centre there and get decent returns.
What period of time is this over?
It was going back. I think it's 30s, maybe.
Was it?
The S&P started in 30,
Don't quote me on that, I'm afraid, but I would say over pretty much any data set that you could get, this would be a similar story.
Yeah.
This is what I was expecting to see. Hence, it made it into the article.
Very good.
But it makes sense, doesn't it? If you've got reasonable growth but not too high, markets perform.
Yeah, 100%.
Return on capital employed.
That is enough on the economy. Have you read Buffett's latest missive?
Certainly have.
Good
It was
missive
an
of the world.
absolute joy.
So if you haven't read it, Warren Buffett, Berkshire Hathaway, annual shareholder letter. What age is he? He's 92. Charlie's 96, 97.
If anyone is young and upcoming and getting into the investment game and wants to learn about investing, going back and reading every single letter from year dot, which is freely
And
available by Google.
it's 10 pages, right? It's not War and Peace.
Yeah, this was one of his shortest ones ever.
Oh,
They're
really?
normally a lot longer.
Yeah.
Which I didn't know.
It's phenomenal how he writes, and he just puts it down so simply, doesn't he? It's always a joy.
I mean, it's sort of mandatory reading. This one in particular, maybe it's because of what age he is and what age Charlie is, but it just feels I try to take as much from it as possible, because they might not be around. Let's be blunt, for much longer. Certainly active investors. Tell you what I liked about this. It is absolutely dripping in humility. This is one of the best to ever do it. I think the phrase he uses is satisfactory results.
It does.
In an industry that can be quite hubristic, this is a real palate cleanser.
I think good fund managers should have humility, because the future is by default uncertain and unknowable, and therefore making calls, positioning, buying stocks based on what you think might happen doesn't end up happening. You need to have an awareness of that, and he clearly does. And he also the other interesting thing that jumped out at me was that we talked about making lots of very average decisions and lots of mistakes, but only 6 decisions that were really, really good.
Moved the needle.
And really moved the needle over 50 years, 60 years.
At this point, a report card from me, this is a quote, at this point a report card from me is appropriate. In 58 years of Berkshire management, most of my capital allocation decisions have been no better than so-so. Our satisfactory results have been the product of about a dozen truly good decisions. That would be about 1 every 5 years. This thing has compounded at 22.9%, I think, since day one.
4 million% return, isn't that, since going back to...
Yeah, even here...
3.78 million% since 1964 versus 24,700% for the S&P. It's mind-blowing.
You, Johnny, sit on our funds committee, meet a lot of fund managers. How much does fund manager personality and sort of feel come into your thinking when you meet someone that runs money for our clients?
I think different people will have different preferences. I like a very sort of solid philosophy and process, and that's repeatable, and that one that will go through periods that's not going to perform well, whether that's quality growth, whether that's out and out value, whether that's high quality, doesn't really matter. Where you've got, what I don't like is where you've seemingly got a manager picking stocks a little bit off feel and his own whim, and he might be very good at that, and he might be the needle in the haystack, but that doesn't feel very repeatable for me. That feels a bit more hedge fund manager type style, and I think if we're buying some Japanese equities or US equities or whatever it might be, I don't think that's a bit of a red flag and a warning sign. So I want to see a philosophy that is sort of grounded in some academic theory, and why are these stocks, whether that's high returns on equity or just cheap and ridiculously cheap for no real reason. I think for me that's probably the most important aspect. When a fund manager seemingly doesn't really have a kind of structure around his decision-making process and is a little bit making decisions off a whim, then that for me is something that I'm not a fan of.
I don't know if you agree with me on this. I think that fund selection is actually harder than stock selection, because you've got that added variability of the
I think
person running it.
I think what's very difficult is you put a fund into the portfolio for a reason. And the manager changes his mind or changes his style very quickly without really communicating it properly. So I won't mention the US exposed fund, and it's not the one you're probably thinking of either. But I bought a US hedge fund strategy based on a load of swaption exposure to protect against interest rates rising, and then woke up 2 weeks later and a lot of it had been unwound and put into a very speculative streaming business, where 10% of the fund had been deployed. And that's the really hard thing. You invest for all the clients you're looking after into a strategy based on a brief or an update you've had. You make a decision that you very much agree with that strategy, and then the person you're invested with changes it. And actually, the fund we're talking about goes exactly back to what you said, which is that is doing something on a whim.
Yeah.
It's
it
not
also upsets the
repeatable
balance of the rest of the portfolio, right? Because you will have positioned that
does.
fund in the portfolio for a specific reason.
100%.
And now they're doing something totally different, and that undermines the rest of the portfolio.
Yeah.
That scenario that you've just outlined there is why you should never take financial advice from someone who's on the TV, because what they are saying...
Aren't we on the TV?
What? No, no. Listen, you'd be mad to take advice from us. But someone, even a fund manager that goes... Some, multi-billionaire that goes on CNBC and says, this is what I think about the world. Yeah, if that's 100%. Someone that runs money for your clients and 2 weeks later takes, swerves off to the right...
Totally changes.
How do you have visibility when said person might... It is always certain high-profile hedge fund manager thinks the end of the world is coming. We don't get updates on their opinion changing, so that is no way to run your investments.
And again, going back to what you said about being quite structured in the way money is run, is we think about regions and different sleeves of exposure. So, a value sleeve, a growth sleeve, someone potentially, for a region that we might want in the middle. And you need those big teams behind it to make sure that process doesn't change, so that we know where we are. We've added global equity income fund recently because it does something very specific, and we feel in this environment it's going to work very well. The environment of high rates, higher inflation.
Yeah, and that guy's been doing it since 06.
Exactly.
So we know that 06 to 08, his strategy worked really well in a high rates world.
Yeah.
High-ish inflation world,
Yeah.
But the performance through the mid-noughties, when the only thing you wanted to own was US growth, was fairly pedestrian.
Yeah.
But we think we're probably going to a world that looks slightly different to that.
Yeah. And essentially, when a dividend yield gets too close to what the index is, he always has a decent gap. The position gets sold,
Yeah.
and we quite like funds like that, don't we?
Yeah. Yeah.
Fairly
No
structured.
surprises. We do not want any surprises. And
No.
I think that
There's too much going on.
When we get on the funds committee, when we get surprises, we don't mind underperformance. Underperformance is fine and to be expected, but surprises versus expectations in a certain market environment, very unhelpful and unwelcome.
Just before we move on from the Buffett thing, some nice philosophical stuff in here. This is one of Manger's. Early on, write your desired obituary and then behave accordingly. Decent sort of principle to live your life by, I think. So moving on, Johnny, you shared this chart with us. We have been getting a lot of emails entitled "The Death of the 60-40 Portfolio." So the classic starting asset allocation for a balanced investor: 60% in stocks, 40% in bonds. Johnny, do you want to talk us through what we can see here?
Yeah, so we would call it in the UK a typical balanced portfolio, call it 60-40 in the US. We've got 6 negative years on the charts here, and every time there's been a negative year, it's been followed by a positive year, and some of the poorer years, so 2008 was minus 26%, 2002 minus 6%, the following year after a larger drawdown in the 60-40, you've had a very strong positive bounce back return. So plus 25 in 2003, plus 23% in 2009. So it's not a surprise. I mean, if you think about it, this comes back what we talked about before. If you go back to January 2022, your 60-40 was made up essentially of bonds yielding 1% and equities trading on 20 times earnings. So you roll forward a year, bonds are now yielding 4% and equities are now trading on 15 times, depending on where you want to put the earnings. Well, that's, a totally different landscape. Oh, we've already talked about property, Segro, etc. is down a third. So, if you think about it fundamentally, then a 60-40 investor is buying assets today that look substantially better from a valuation perspective. And valuation doesn't help over the short term, makes not a jot of difference over 6 or 12 months, to be fair. But over 5 or 10 years, it is probably one of the only things that matters. And so, yeah, I mean, it's sort of natural to think that when you get a strong setback, like we've had in years gone by, that we get, a decent bounce back.
I think you don't necessarily need a great economic outcome to see a good return for a classic portfolio this year. I personally think the utopian outcome end of 23 is if rates are where they are at the moment or a little bit lower, and equities sort of muddle through.
Inflation down, but not back at 2.
Not cratered.
No.
And in that environment, your bond allocation ticks along at 3-4%. Equities, let's say, 5-6.
I think as a starting point today, I'm quite excited. I think if I was sitting here this time last year, I was not excited because things were so unknown, so much panic around. I think we sit here today, we've got, we said it last week, but very, very good quality corporate bonds, yielding 5-6s, short dated. You've got
Cash.
Yeah, exactly.
Cash yielding 4.
Exactly. You've got natural dividend yield from the UK of 4ish, maybe it was slightly under 3.8. Fine, the US doesn't yield as highly, but again, that's ticked up because of the constituents, and valuations have come back a bit. So yeah, I completely agree. I think we're not forecasting, but we're starting from a much lower multiple of earnings. And on the other hand, all in truth, since the financial crisis, we've really been sitting here wishing that rates go back to what we deem as a normal environment, which is savers get a reasonable return on cash. It's really important. Inflation is the bit we all worry about, but as John says, if that's tamed or slightly lower by the end of the year, I think this year will be. It's a very good starting point.
Given what we said about economic projections being absolutely pointless and impossible, frankly, you're starting as an investor. Take the emotion out of it. Your starting valuation, expected forward return is, that's your North Star, right? And
100%.
Times will change, things will happen, unexpected things will happen. Of course they will. But if history is any guide whatsoever, if you sit through that, then you'll get a cracking outcome. And doubly so if you get a decent starting valuation. I've absolutely no idea what this will do. I think actually what we saw last year was very, very painful, particularly in the bond market, but I think it was a necessary reset, not just for investors, but also central banks don't have to resort to unconventional methods of policy the next time we go into an economic slowdown. We can cut rates. They probably won't cut them to where they were before, or certainly, it would be better if we don't do that.
I don't think central banks ever want to go back to that environment.
No.
I don't think they ever want to do QE ever again.
Fewer tools in your armoury.
Yeah.
Also, there's so many companies that survived on the basis, we call them zombie companies, but so many companies survived because debt was free, and they shouldn't have survived. And actually, we're seeing it in some of the businesses we own. It's corporate Darwinism, which is survival of the fittest, and good companies take market share, and they grow. Even in a bad environment for the economy, they grow earnings because they are great businesses, and other businesses fall over. And I'm not saying businesses falling over is a good thing, but quite often these businesses weren't really working anyway. There's a chance for people to do something else or to be more entrepreneurial and have an opportunity. Quite often it's a kickstart that the economy needs.
Where if you were gambling man, where do you think, in what sector the next exciting company comes from? Do we see some sort of energy type name? Because as we were saying a couple of weeks ago, that sort of sector has been starved to capital. And
the last 10 years was very much tech led. We've already said we think the next 10 years will be led by a very different set of businesses. I think energy transition, renewables is it's easy to see that sector really doing well. I think on the other hand, I think healthcare and biotech. I think there's a lot of excitement going on there. You've got Moderna. They are making huge leaps forward in terms of technology around testing, and where they are with developing vaccines. Some of these biotech businesses are trading at less than cash value on the NASDAQ. I think at one stage last year, over 30% of NASDAQ biotech.
I remember looking at a biotech
trading
ETF, and it was just
but the good biotech businesses are going to be taken out. They always are by large pharma because they need that development. But I think we are potentially at a pivot point in terms of how we develop. We're absolutely at a pivot point in terms of how we develop vaccines. But I think the health system is going to leap forward. So my money's on sort of healthcare and medtech and wearables and things like that.
I buy that. I can see that. Just on the point about earnings growth being really positive coming out of recessions, and you tend to see some exciting companies coming out of recessions. One of the prevailing narratives of the US market in the 2010s was that it was all multiple expansion because of zero rates. Per Jack Bogle, that doesn't actually appear to be the case, and the number one driver of the annual returns that you saw during the 2010s was earnings growth. Global financial crisis creating some of the most exciting companies in the world.
I'm not going to pick holes in this data whatsoever because it tells the story, but if you start on the 1st of January 2010, the earnings were already depressed following the financial crisis. So you had a massive snap because corporate earnings fell 50% in 08, 9, 10 because the banking sector basically went bust. So I just wonder whether the start of the 2010s coincided with a very depressed period of earnings. So, not to pick holes in the data, but that might just, I wonder if you move that on a year or two and start in 2012 or 2008, whether that looks a bit different. But, earnings growth...
Good multiples have been artificially high then as well in that scenario.
Yeah, absolutely right. So... it's interesting, there haven't been many decades where you've seen multiple contraction. The 70s is the one that jumps out. Look at that, you had earnings growth of 10% a year, but annual returns on stocks were only 6%, so you had a 7.5% a year multiple compression, which is quite savage. And the 70s, if there's one reason why we're all paranoid about the current environment of high inflation and rising interest rates, is because we've all read about the 70s. And it's fair to say, if you owned most assets in the 70s, you did not do very well because inflation killed most assets. You wanted to own gold and land. Equities, earnings and dividends kept pace with inflation in the 70s, but you lost so much on the multiple side of things that in real terms it wasn't a great time for equity investing, and for bond investing it was even worse. So it's interesting just to pick out little periods and sort of, if there's one thing I guess that would keep me lying awake at night, it is a return to that 1970s environment. I don't think we are going to, but it's a sort of again it comes back to that probability scenario analysis, and there's a sort of 5 or 10% chance that we have a sort of 70s type environment, and it would be pretty bleak.
The longer oil stocks hold up, the more I'm convinced that the reason that they're held up is because people are buying it as an inflation hedge, because the oil price is cracked. And one of the things that would typically work in that scenario, I don't think that's people's base case. Yeah. I don't think it's our base case, any of us. No. But if you're going to own something that should theoretically do okay in that environment, I think oil stocks and on an undemanding valuation and paying you, 8-9% dividend yields.
Well, commodities were about the only thing that did okay in the 70s. So it was gold.
How's gold doing at the minute?
Gold. I got an email during the week from someone I love reading from, and there was a little piece in it which said, in what environment does gold perform? Does it ever perform? And, I've said for years, gold, when there's inflation, gold performs. Oh, but not this time because rates are rising. It never performs when rates are rising. And then, we'll go to JRCFA. When does gold perform?
I don't know. It's unexpected inflation.
It's unexpected.
It sort of dances to its own drumbeat, doesn't it? It does its own thing.
Very hard.
And falling real yields. No, I don't think this episode we need to get into the difference between real yields is essentially bond yields less inflation. And when that's falling, then you tend to see gold do quite well. But I totally agree with you.
It's very difficult. I mean, we've used it tactically in portfolios, and at times, we have made money from it. But gosh, it's got very difficult.
You got the currency overlay as well, because obviously it's inverted to the dollar. So when the dollar goes up, gold goes down. But then if we're buying gold in sterling, then that sort of works the other way.
It's sort of hard
to scratch my head a bit, and it hurts. So I just think, can I just buy some quality equities?
Yeah, I think as you go back to on the oil stocks, great dividend yields. It's oil's reasonable inflation hedge. Why wouldn't you do that instead? It's a bit simpler.
I think I'm biased against gold because the first fund manager meeting I ever went to was a gold manager in 2011.
And he thought the world was ending.
I was like, have you heard of gold, lads? It's going to $3,000. And of course,
that was the top.
That was the top. Of course it was, because, puts you off the asset. That's us, guys. You have fun?
It was great.
Good.
Loved it.
Really enjoyed that. What are you up to at the weekends?
What am I? Do you know what? We've got a free weekend, and I'm really looking forward to it. I'm hoping it snows again, so I can take the little ones out, have some snowball fights.
Amazing.
But no, one of the rare weekends when we've got nothing planned, so very much looking forward to it.
Brilliant. What about yourself?
Well, Wales have got the wooden spoon decider in Rome, and I haven't checked the odds, but I'm going to assume that Italy are favourites because they have been playing some decent stuff, and
Uh-huh.
Wales look
Good against Ireland.
But
Isn't it the World Cup next year?
World Cup's next year, yeah. No, this year, sorry.
This year,
2023,
yeah. Yeah.
October.
Sorry, of course,
Yeah,
yes.
this year.
And we've got you in green on the other side.
Got the
You
boys
must
in
be
green.
very chipper.
Doing
Number
alright.
one.
Doing alright.
Playing very
Ireland
well.
are just doing the classic thing. This is the most Irish thing in the world. We can't do too well because then we'll pick before the World Cup. Then if they do poorly, why aren't we playing better?
Yeah.
We just can't be happy.
Haven't you
Yeah.
got an English coach though?
Very good. And half the team are Kiwis, but apart from that. Thanks very much, folks. As usual, if you want us to discuss anything specific, drop me a note on david.henry@quiltercheviot.com. Thank you to JR and
That's
to
lovely.
James, and we'll see you next time.
Thank you.
Bye-bye.